Hi, let's cover NETC. Starting by the charts, this is the all history chart going back to the company's IPO in 1996, which was at more than $200 a share. Then it came off to about $10-20, and then a big bull run again on that technology bubble to $350 plus dollars, came off to almost zero. And over the short-term chart, we have a bullish trend here above the 50 days and the 200 days moving average, with some sharp corrections, but no doubt the chart is bullish, with the right part of the chart above the left part, at least on the over the short term. As for fundamental analysis, let's see this. We have here the number of shares outstanding since 1997 until now, and the market cap, which is this yellow line. The current market cap seems to me to be $4.33 billion, but Yahoo has just 400 plus million, and MarketWatch has about 2.33 billion. So there are some doubts here about the conversion rate of the ADSs. I didn't have time to check it out very well, so I have some doubts on this, but at first sight I see 294 million shares outstanding, and that means a $4.33 billion market cap. The share count has been growing a lot over the years at a 21% compound annual growth rate, so heavy dilution on this company. And the market cap has been growing just 1.5%. All of this due to the share count increasing, not the share price. So not a good situation here. Let's check the balance sheet. Well, we have 421 million in long-term debt, and the current ratio, although it is better now than what it has been in the past, is still below 2 at 1.86. So this is a weak balance sheet, even though cash and marketable securities account for 58% of total current assets. So weak balance sheet. Revenues. We have here, there wasn't much growth between 97 and 2003. You can see in 97 revenues were $314 million, and in 2003 there were 392 million. But since then revenues are growing nicely here. 467 million in 2004, 661 million in 05, 901 million in 06, and for 07 expected $1.36 billion in revenues, and for 08 $1.61 billion. The gross margin has remained more or less stable here, just below 40% over the past few years. Revenue compound annual growth rate with a base year of I believe this is not 1997. Let me see here, just a second please. Where is this? Revenues. No, the base I have here is 2003. So not let's put back this, not 97, but since 2003 here, revenues are growing at 36.5% a year, and the industry average is growing just 4.8%. Price to sales ratio for our company is 3.18, and for the industry average 2.51. Let's move on. This is earnings per share and net profit margin. Well, the company lost really a lot of money between 97 and 2004, where they still were losing money. A bit of a profit in 2005, 21 cents, and in 06, 70 cents. For 07, analysts on Yahoo are expecting 39 cents, so an earnings decline here. But maybe this is wrong. This is really very weird, because revenues are expected to grow. And for 08, 61 cents a share. Also weird, because we had 70 cents in 2006. I wonder if there were any extraordinary items here affecting these results, but I didn't have time to check it out. Net margin in 2006, 22.7%, so about 22% net profit margin, and the price to earnings ratio, considering not 2007 but 2006 numbers, of 21 times earnings, and the industry average is 19.8. So I've designed my valuation model for the next 3 years, but you can see I had some doubts on the data. There are discrepancies between Yahoo and MarketWatch and my fundamental data service from alphatrade.com. So I would have to dig further, but I'm not very interested because the company has been diluting shareholders' value a lot on an historical basis. So management doesn't have respect for shareholders. So I'm not really interested in this stock. Anyway, my valuation model, well, this is a bit complex, but the conclusion is the stock is not attractive because the share price is expected to grow just 11.6% over the next 3 years on a compound annual growth rate basis, and I'm looking for more than 16%, so this is not attractive. Okay, thank you. So my rating on a 1 to 10 scale is 5, because I don't expect the stock to go down unless there's more heavy dilution, but I don't expect it to beat the market by much either, so 5 is my mean rating. Thank you, bye.